And I still have the Feb up because I already had the charts set up on this that we're coming into some critical support here, this 89.50. You can see right here, confluencing with the 90, which is the 61% of the move from 71, which is back here, to 1220. And what I was pointing out with the, comparing to the euro, is I said that the euro wasn't as mature. The move, the technical move, wasn't as mature as the gold market had been, because we had talked about this on the last, few days. That it looked like it was really tired. We had already come so far, and we're looking for a move lower. That's opened the door, and actually on this move down here, I thought we were going to see 91 and then pop up. That ended up holding here into the 96 area. We got past it, and the market started moving higher. And let me go back in here. That was actually right in here. So yesterday we saw this nice pull down. I even thought right now yesterday we might even dip in here into the 90s. So we finally made it here. This is a pretty decent area right in here. You got the 61%. You've got the 89.50 here. So this is a pretty decent area. As I told you, I think that eventually, before all said and done, it'll get down to 81. And we got this 80 right here. We pointed that out yesterday. But this is going to be a very nice, I believe, a decent pause area here in the gold market. We even talked to yesterday that if we get a bounce, it may take us up here to 1201. I'm not even sure if it'll make it up there. We actually did. We made it all the way up to 1202, and you can see that they reasserted themselves back to the downside. So we'll get back to what we're talking about on the euro. One of the things that's weighing on gold right now, continue to weigh on gold negatively, is going to be this U.S. interest rates. And, remember we talked about that over the last week and a half. And one of the things I wanted to point out was this about last week early on. One of the traders, one of the guys here in the webinar was making a comment. He said, you have to be willing to adjust. If you're going to succeed in the markets, you have to adjust. And that's what you're having to do. All these markets, if it was that easy, everybody would say it's going to go here, there, and that's it. You have to be willing to adjust to what the market's doing. So we talked about how over the course of the last few weeks, gold would respond very positively to any up moves in the bond market. And throughout here, really on the way up, if the bond market made a dip, gold didn't care. It's like, okay, who cares? And then once the bonds would start to reassert themselves up to the upside, gold would take off. But that can only hold for so long. And that's what we talked about yesterday when we said, hey, look, a further break in the bond market, I think that's the day before yesterday, further break in the bond market is going to limit the euro's upside. So at some point, those concerns in the bond market eventually started to weigh in on the gold. Now, gold had already started to turn negative. It's not so much that it was negative, it's just that we've come so far so fast. And we talked about this when we were above 12. I said, hey, look, you're going to have to, we need to get, in order for this move to continue high, we're going to have to get brand new buying. And we had talked about, move down here, and other banks, technical analysts were looking for a move down to 71 to get long. And we hadn't even got anywhere near close to that. So once we got up here, it was going to be hard for this market to sustain itself because you need new buying. There's going to be people that are saying, I'm not going to buy at that level. And so then we started to look for setups where the market could work lower. And we talked about it here when we said, okay, now we're above 1530. As long as the market doesn't get above 18, we should be seeing trouble between the 16 and 17. And there we go. We opened the door for the downside, even went further. But now, as the bonds have been under so much pressure, that's when now the market starts to look at everything. The glass is half empty, and everything's negative. So then now the bonds, which they didn't pay that much attention, well, the bonds have been going and falling and falling and falling. At some point, then they were saying, well, I can't buy it now. These bonds are really under pressure. So even though we've come into support, and that's going to provide a little bit of short covering, I think it'll provide a pause. You can see where now the market's, I wouldn't say flipped, but now it's focusing on all the bad news, whereas gold before didn't care. Everything was good news. Trump says something bad. Well, that's political. That's some political uncertainty. Bid the gold up. The bonds are moving higher. Okay, great, fantastic. Lower rates. Bid the market up. Well, now the bonds are going lower. Oh, who cares? We don't care. We're still going higher. Whatever it was, the glass was half full and nobody cared. But like I said, we've come so far, And now after falling and as bonds continue to fall, then it's like, whoa, the glass isn't half empty, half full anymore. Now it's half empty. Now everything's negative. The weather changed. Well, that's negative for gold too. So that's what I'm saying, how these markets change, and why I said why I have these levels, because all you're doing is you're looking at the market moving from level to level. You're not making any money trying to make a claim it's going to go here, there. Ultimately, it's just a move from level to level. Although the week before Christmas, we've been looking for a move to 1220. I didn't think we'd get there that soon. I thought it'd be at the earliest the first week of February. So let's go and get back, and you can see here we're starting to bottom a little bit here at this 1189, which is confluencing with the 61%. So let's go and get back in the euro so we can update the bias chart. So how we got to talking about gold, we were talking about, you know, we were talking about yesterday how the euro was coming back up, and I said, well, you know, it can pull back. We might even push to a little bit higher high, which it did ultimately pull back. And Paul was saying, hey, we're on the right ascending wedge, and it looked like, wow, it is going to slide after all. But look, we turned around, we took out the low, we took out the prior day's low, remember here, and now right here, and we've held, and we're holding up here. And the market, it's starting to resemble a little bit how gold was before. But right now, like I said, this market is looking for a catalyst. I still think we're going to break lower. I think that this is on a 2-hour chart, and you can kind of see the similarities the way the gold was, although the gold was on a 30-minute. Just from a technical standpoint, I think we're going to have to break lower. And we have this 686, and then here's our ultimate area. But like I said, this market is really trying to fend it off. Now, we're really oversold the bonds, so if the bonds can start to hold themselves, that'll open the door. Maybe we'll kind of hang around here. But at some point, I think we have to go and pull back just from a technical standpoint. It's just that it's being exceptionally stubborn right now. So right now, until we get above it, we'll go on a very shorter term basis. We'll mark the highs. The resistance on a shorter term basis has got to be the 758. 816 is our overall short-term resistance level here that we're looking at. If they blow some stops, I guess we'll leave the 816, but I'm saying there's any moves, you're going to see a lot of trouble against the 758. Maybe they'll try and make one more last hurrah, and we could see on a fib extension of this recent move where that would take us. 816, that'd be the 161% of this recent move, right in here. So we'll leave the 816 for now. And support, we're going to leave it once again here at the 686 for now. So that will stay. And we've already done the cable. So let's go and move into the Aussie. We talked about the Aussie. We showed that yesterday. The 75.72, we saw a very nice pullback from that area. I mean, the pullback was close to about 50 pips in there, and then now we saw a pullback or a rally right back into that same area, the 75.72. It actually even eclipsed the prior day's high right here, because remember we talked about it, put out that chart and said really any moves to 75.75 would be an area that would be defended for shorts. And the high was 75.76, and we saw a very nice pullback in here. Then we saw the market, you saw a nice hammer bottom, the market reasserted itself. We take out some stops just above this area, and here we are rolling back down. I think we're going to just have to get, like I said, we've come so far on this market, I think we're just going to have to work lower, just from a technical standpoint. I think the first stop is going to be this. We got 74.30, 74.37, and I think we marked it at 74.25. 74.30 is still good right there. And on the high, we marked at 76. So nothing's changed on the Aussie. Got 74.30, 76. And we'll update this because that should be bullish. And we're going to move into the Kiwi. So we're clipping along now. So in the Kiwi, we were looking at 71.23 and 72.50. And we had even gotten up beyond the 7250. We talked about this area being the bias pivot, and we even got up here. Well, the 61% basically 7250 here. But look, holy smokes, we even made another run up here. Now, there were some nice touches right here. I'm surprised it even got up this high. We talked about Westpac from a week and a half ago was looking for 68 cents. They didn't get the, look, they're a long way from 68 cents. But as I mentioned earlier, the concerns are about the Trump rhetoric and how that's going to impact the dollar. And we saw some nice Kiwi data. So it even pushed even further here. We also seen a nice pullback. Once again, I think this, just like we talked about the Aussie and also just the Kiwi, it's met and exceeded its expectations. Now it looks like we might have got people to really finally throw in the towel. I don't trade the Kiwi, but you can look at it from a 2-hour chart. You see here, you've got this little, it's almost like a spinning top, except the wick's a little bit long. And so when you get a spinning top, this almost looks like a spinning top, but almost it has no wick on the upside right here. But this is almost similar to that. I would not call that a long-legged doji. I mean, if you look at it on a super short-term basis, you might think that. But pulling it back out a little bit further, that would be closer to almost like a spinning top, except that the wick is just a little bit long. And generally, we get a spinning top means you're losing momentum. So you're thinking, okay, which way has the market recently gone up? Well, it's been up, and took one more extension. That means we're probably running out of gas. We come up in here into the 73 area, and traders, start to think, you know what? I can't believe we got here. This is as good as it gets, and then we take off. We drop off of that. We're going to see where we were actually on the 78%. See where that ended up coming out. Yeah, golly, we even kept pushing even higher. So that was a 72.85 for the 78%. Even got past that. But just like the odd, I think that we've come so far so fast. We've exceeded our levels, exceeded fibs, and I think right now we're gonna have to open the door for a little bit of a correction here. Support. Well, you look at this bias pivot, but on a very, very, very short-term basis, this support would come in at 72. I think we can get to 71.57 easily, and if we're correcting back, and this is a high here, we'll probably see something closer to a 38% before you see a more significant bounce. That would come in at 71.40. But we'll go and mark that off. I mean, it's still in a bullish mode, but if we're gonna the start of a correction, then we'd be looking at that. We do have 72.06 as a 23%, so we already said on a short-term basis is going to be 72 for support. Resistance will be at 73, so let's update that. I think that 72 will be defended. I mean, you might dip a little bit below that, but I don't even know if it even make it anywhere close to that 73. But not that we're calling for it. But you could start to see the very inklings of, take a look at this. So if we get a pull down to the bias pivot or even just a little bit below it and come back, we could have, this could be the early things that we'd be looking. I'm not calling for head and shoulders, but I'm just saying we'd be looking to see if it comes down here to 72 to 73, that would point to about 71. If that were all to come place, we're early. We have to see it come down here towards 72 and what, like 72.10, hold back, rally back up towards 72, whatever, it might be 60 or something like that. And then you could say, okay, but it's still early, but we'll just keep that there as food for thought. So the next thing we got to go into is the dollar CAD. We talked about that. It looks like it's probably going to end up going lower. Let's see where we're at now. I think we did get down to that 130 area here. And I actually got down here before that. Actually came in, there's our support right there. 30.50, and the low was, see, there's our bar here. See, there's a little intraday bar. The low was 30.54, and support was 30.50. So let's take a look. So it's 30.50 and 31.90. There's our bar here. We're looking for support. I even thought it could even go below that. You know what I mean? Go down here to this 130. We were even talking about, remember, I think we were saying we eventually would probably come down here towards 29, but the shorter term support on our bias chart was 30.50. The low is 30.54. I'll go with resistance here. I don't know if we already marked that. Here's the 31.71, but I like this, the little part of this little upper zone, and if they got a little bit oversold. So 31.90. I mean, this 30.50 held up really well. I mean, if they go lower, we'll probably get some support at 30, but I think we end up going beyond that. So we'll keep the 30.50 there, and we'll just call resistance at 31.90. So 30.50, which held 31.90. Oh, we already had that. And it's bearish. So let's take a look at the dollar Swiss. We're looking for 99.30 and 0.0621. Oh, boy, we're really trapped in this range here. I mean, trapped in a very tight range here. So let's back this up and see what things look like on a bigger perspective. I think we're just going to come down. We talked about 99.30. Oh, yeah, there's our 99.30 right here. I'm going to keep it there for 99.30 because it looks like the dollar's going to make one more less drop, which potentially could open the door for the shooter. The year's struggling up in here in this area. Well, I think eventually it's going to work lower, but it might allow us to pop into the upper 50s, and that might coincide with this dollar Swiss taking one more little dump. We've got 99.46 at 50%, but this area here, that 99.30 looks good. You see right here, there's a lot of volume in here. You see how that was support here, 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 just a ton of volume. So we'll keep it at 99.30, and resistance is going to be this 0061. I'll get rid of this. So this 99.30 and 0061 here. We can even look on a little extension, but I don't think that's going to make that much difference. We'll take a look at this extension. What would the 161 take us? 99.21. Well, I'm still going to stay with the 99.30. and 0061, but this thing is really trading in a very tight range. That's what I'm saying is I think we could have one more down move here. That might open the door for the euro to maybe, I don't know if it would make outright highs, but it might punch the euro up about 35 pips and then eventually fall. But I think we're going to have to come down here. Technically speaking, the dollar Swiss looks like we're going to have to come down here, this 99.30, and there's the 99.30 right there. And we'll keep this as 0061. That's going to remain the same. So dollar Swiss stays the same, 99.30, 0061. This is now turned bearish. Once again, most of our stuff is more geared towards shorter term. Let's see if we have time to do the dollar yen. Yeah. So the dollar yen, we had 1255, 1439. Look where we went to right here at 1439. They didn't take this dip to 1255. We're looking on a very short-term basis. Resistance was at 1439, and we stopped at 1440. And this is the conundrum because, look, we talked about this yesterday. The dollar yen should be rallying based on the, let's take a look at this. Based on the inverse relationship with bonds. And so here's the bonds going into the frickin' toilet. And what the heck? Why isn't the dollar yen a whole lot higher? Well, the reason the dollar yen is not a whole lot higher goes back to the same thing. We're getting all that Trump talk, the rhetoric, and the yen is considered a safe haven currency. So, yes, we're coming off our lows because the bonds keep going lower, which is pushing the dollar yen higher. Our resistance was for 1439, and we made it to 1440. But once again, we said that on a longer term basis, I think we're just going to have to come down here before it's all said and done, down here towards this 1165. Let's. If the dollar gets whacked again, the bonds are really struggling. I mean, we'll move the resistance. It hit our resistance. We'll put the resistance right here. I'll show you. Right there. You see there? So that'd be a pretty good stretch, I'll tell you that. It'd be just a little bit above 115. 1506. So we're going to put it at 1506. We did get our resistance here, 1439. This 1482 is pretty solid here. I mean, if they want to goose some extra stops, they can get it to 1506. But if they, once again, we talked about it, the dollar goes lower, and the dollar's going lower, but not on a good situation. It's going lower because we're getting scared. The market's getting scared because of the Trump rhetoric. So once again, the dollar yen trades with an inverse relationship to the bonds. Look at the bonds. They're going in the freaking toilet right now. And I already said that the concern with the bonds is because now they're not focusing so much on all the stimulus. Now they're focusing on, because the rhetoric's so negative, they're saying that the way the market's looking at it, that we need foreigners to buy our debt to manage our big, huge account deficit. Well, they're getting spooked. At least that's the way the market's reading it. And so that's weighing this pressure on the bonds. So you would think the dollar yen would be going to Venus, but the yen's a safe haven currency. So it's a push and pull on who has more control. Right now, with the bonds going lower and higher interest rates, that's allowing the dollar yen to go higher. But how much higher, I don't know. If we get this scare into the bonds, we'll have to check support. We could push it down here, and I pointed out to the guys earlier, tweeted out the chart on the WizeTrade alerts. We had supported 49.02. We dipped just below 49. We rallied them up to 49.10. And now we're starting to slide back a little bit. We could take one more move again here, and that's going to weigh on the dollar yen. It should be positive, and actually very positive for the dollar yen, but the dollar yen is getting weighed down by the yen as a safe haven currency. So we're already a break. I think we're already a break. Yeah, we're well over break now. So we'll be back, and we'll finish covering that. Thanks for joining us here. We'll finish covering on the dollar when we get back.